Welcome to the Big Mike Fun Podcast, where you learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlotnik. And today it is my pleasure and a privilege to welcome Jake Vanderslice. Hi, Jake.
Hey, Mike. Thanks for having me.
Thank you for coming. Jake is a brother from the Collective Genius Mastermind. He's also in the Freedom Founders Mastermind. And he is a brilliant mind. Love working with him. And he's a specialist in self-storage. Jake, tell us a little bit about your family. That's the most important thing. You manage a lot of self-storage facilities. I know you have other investments, but your expertise is self-storage, but most importantly, your family. I know you got a couple of small kids.
We do. We've got two boys. One is almost 2.5, and the other is 10 months. So got a lot going on at home, but they're a blast. I come to my office all day and work and get home and the fun continues.
Yeah, that's the why. It's very important to have a great family.
Yeah, they're doing great though. Our youngest is getting close to walking, and our oldest is beating up on him nicely. So it's a lot of fun at home.
Yeah, and you got to watch out when they get mobile.
That's right. Yep. We've got gates and stuff all over the house and outlet covers and you name it.
That's right. So tell the audience a little bit about you. How did you get started? How did you wind up in self-storage?
Well, I got started investing in real estate full time in about 2005. I was in the fire service and had a lot of days off, and got busy doing real estate and quit my job. And I've been unemployed ever since. We've done about 1,200 fix and flips over the years, and we still do those. We got into commercial real estate in 13 and 14 with various adaptive reuse retail projects around town, just converting old warehouses into breweries, restaurants, yoga studios. And then we got in the self-storage business in 2015 with some institutional partners. And we like the space because it's scalable, repeatable, predictable. And the data at the time suggested that it was historically resistant to downturns. And so far that theory seems to be holding water in this downturn. Obviously we got a lot of uncharted territory in front of us. But yeah, we grew the portfolio from there, expanded into multiple states. We launched a fund last year. We're launching a second fund in Q4 of this year. Really the goal of our self-storage investment thesis is just repeatable, predictable revenue streams with downside mitigation. And we found that asset class is a good vehicle to be able to realize that.
I agree with that. And as far as I know, you're investing mostly in existing facilities that have cash flows with some value.
We've done a fair amount of ground up deals over the years. Really the last 2.5, 3 years, we focused on value add existing facilities. We've bought a few deals at certificate of occupancy that are lease up projects, but we like the immediate revenue generation when you buy a deal that's already substantially occupied with good historic financials. And we're not going to be developing ground up anytime in the near term, just given what's happening out there with this environment. So yeah, we're just focused on existing facilities right now that are inefficiently managed, inefficiently marketed, and we can leverage our management and technology platform to make them better.
It makes a lot of sense. The cash flow is a sort of it's a secure feeling to have a cash flow today, and if you start with decent cash flow and you can improve it, it's a whole lot less risk than taking on a full lease up. So just for the audience, on a normal lease up, how long does it take to lease up a facility that's certificate occupancy ready? It's basically ready for lease up. How long does it take to lease up?
Yeah, it depends on the market. Easily 18 to 24 months. You could see a 36-month lease up too, just depending on the supply ratios in the submarket, your rates, your marketing. But it's a long-term endeavor to stabilize an empty self-storage facility.
Yeah, it's a painful process. At least it feels that way. So, but the beauty about self-storage, so what are the main benefits of self-storage? Everybody knows about no tenants and toilets, but beyond that, what are the big benefits?
Yeah, one of the main things we like about the asset class is the granularity of the income streams. You're relying on, in our case, thousands of people to pay us tiny bits of rent every month. Versus in our retail projects, for example, we have a brewery paying us $15,000 a month, and they're either going to pay or they're not. And if they don't, it's a long process to get them out and find a new tenant, not to mention very expensive. In self-storage, people are paying you $100 a month. And if they don't pay, you can turn off their gate access, you can overlock their unit and get a new customer in there that is paying. We also like the fact that the revenue management in self-storage is very dynamic. So in self-storage as an asset class, you can respond real time to supply and demand changes within the submarket because the leases are all month to month. So for example, if you have a unit type that's in high demand, you can incrementally raise rates on that unit type. And likewise, with the unit type in lower demand, you can lower rates until you drive occupancy and start to increase incrementally over time. So we like how dynamic it is on the revenue side.
I like that too. As long as you don't get an oversupplied market, as long as you don't wind up in a situation where you have to lower the rents. But I do completely understand the thesis, and it's kind of interesting. Even the big boys, the CubeSmarts, have optimization algorithms that drive the occupancy first, and then when the occupancy is high, then you push the rents up.
Yeah,
So,
that's the game. You're not as concerned about rates when you're in lease up, and once you get to a critical mass, you can start really
pushing rates up,
and really optimizing your revenue streams.
Yeah, it makes a ton of sense, and makes sense. So let's talk a little bit about your funds. I know you closed your first fund. I know you're working on a second fund. The first one, are you done? You completed all the capital raising and acquired the assets?
We're really close to closing it out. We've got a few more facilities that we're closing this week and next week. We've got a portfolio in Tennessee that closes tomorrow. And we've got a single asset deal in Southern Illinois that closes the following week. And after those deals are closed, we'll be really close to closing out the fund. We might put in one more acquisition before we close it to new investment and new acquisitions. But the fund really has been focused on predictable dividend and yield to our capital base, which is why we've acquired facilities that don't require substantial capital improvement budgets. Deals that don't have a lot of heavy lifting on the value creation side, especially kind of in and post-COVID. We selected acquisitions that were financially good enough to not make it better. They just stand on their own without improving the revenue stream or optimizing expenses. And obviously, we believe we can do both those things and add some more meat to the bone. But yeah, we're getting close to closing it out, and we're still working on structuring Fund 2 and what that looks like. But hopefully that gets off the ground by the end of this year. And I think overall it'll be a pretty similar strategy, just larger basis deals and some more geographic diversification.
Sounds good. So what kind of distributions have you been paying in just the first fund?
Yeah, our capital structure is fairly simplistic. We have an 8% accumulating preferred return. Every distribution thereafter goes to pay down capital accounts. After capital accounts are returned to investors, everything is split 70-30. Whether it's a distribution from operational cash flow, refinance proceeds, or a sale. We've made our fourth consecutive quarterly preferred return distribution about a week ago for Q2, and we anticipate being able to do that moving forward. And you mentioned earlier, Mike, when we got on the podcast together, how important cash flow is right now. And the old adage that cash is king is still important, but I think today cash flow is king, and people just really want predictable, repeatable dividends. And if you can create that, that's compelling.
Yeah, agreed. We're dealing with a yield-starved environment with rates having dropped where they are. There's really no great alternatives in the Wall Street. The bond yields are very low, unless you're dealing with the really junk bonds and you're buying into high-risk stuff. But if you're looking for conservative cash flow, hard to find. So 8% is not bad. But what's the target return? This is a closed-ended fund, as I understand it. What's the total return following the waterfall? 8 pref, 70-30 over 8. What's the target total return?
We're targeting a 16-18% investor level IRR, so net to investors, and that translates to just under a 2x equity multiple over a 5 to 7 year hold. And we're forecasting roughly half of that return to be realized from distributions from operational cash flow, and the balance of that return to be realized either with a recap, refi, or a sale.
Yeah, I like it very much. There's a big part of educational content they've put together in the past, and we also look at this stuff, is what portion of a total return comes in cash.
Yep.
So if that number is low, if you're getting 25%, then you're really speculating on the back end for the thing to sell at a price or number of facilities to sell. But if you could generate 50% plus, at least you lock that in, and even if the exit price is not as great as you project, it feels that you've gotten substantial portion, at least half of the return in the form of cash.
Yeah, if it doesn't go well and people get distributions from preferred return distributions along the way and get their money back, it's not a home run by any means, but it still created a passive, reliable dividend. So that's mainly what we're focused on, are distributable cash flows current.
Yeah, makes sense. We got to talk about your fund too, where you're trying to scale up. You'll be dealing a little bit more competition when you get bigger. So you start going after the big acquisitions. It's a little bit more competitive, but you also have the economy of scale. So it's kind of interesting how it's going to look.
Yeah, larger basis deals certainly drive down the yield on cost, both going in and the yield on cost stabilized. But you're also deploying more capital. Arguably, it's a better asset because it's larger and probably newer. But we're certainly going to have some challenges in the acquisition side, sourcing deals that make sense, as we've always had through our entire careers. Finding good deals is difficult all the time.
Yeah, it is. It is, and that whole thesis. The reason it's gotten very competitive because of the REITs. They've come in and they've gobbled up a lot of these 60,000 square feet plus facilities, many of them 100, 120 and higher. So they have the capital utilization problem. So they're paying lower and lower cap rates as they got to put the money to work. But my theory, and it's just a quick, and it's an opinion. It's nobody got a crystal ball. The way I like to put it, my one broke and I can't find a new one for sale. So, but the thesis is this: as the interest rates drop, the cap rates should match. So directionally, we had COVID, which is terrible. It's a pandemic, and we're all suffering from health-wise and economically. But on the other side, you got drop rates. So what Fed has done is created an environment where investors are willing to take lower cap rates because of the cost of capital is cheap. So it'll be interesting to see what the financing looks like. By the way, you're acquiring new facilities now. So what has happened with the rate available to finance these facilities? Has it dropped in conjunction with the Fed dropping rates?
We typically leverage commercial banking relationships to finance our self-storage facilities. Unfortunately, the asset class doesn't enjoy the financing benefits of multifamily, which, to your point, Mike, is a big reason I think cap rates in that asset class are so low. When you can lock up 30-year non-recourse debt at a 2.5 to 3, you can pay a pretty low yield on cost and still make a decent equity dividend. In self-storage, commercial banks really have gotten to kind of an interest rate floor where it doesn't really matter how low rates drop. They still need to have a minimum to make a spread. So we've seen our rates drop to around 4%. Nominal origination fees. One material change we've seen as a result of COVID in the capital markets is a reduction in the maturity date on our debt financing. So before COVID, we were typically getting 10-year maturities, which means the loan has to be paid off within 10 years. Lately, we've been only getting 5 and 7-year maturities. So it's not as ideal as 10, obviously, but 5 to 7 years at a fixed rate is still a pretty good hedge against inflation and potentially a rising rate environment down the road. But commercial banks are still lending. We really haven't seen any other changes beyond just our maturity dates and kind of that floor of 4% on our interest rates.
Great commentary. I certainly. So back, you said something that's I believe it's an impossible scenario for me. The rising interest rates is I'm going to make that comment again. As much as people are fearful of rising rates because all real estate prices would soften as a result of increasing rates, I just don't believe the United States can afford high interest rates. We're moving again towards Japan, EU model with likely negative rates. The reason for this is we're printing debt, printing money, Fed balance sheet is expanding, and the debt service on national debt and continuous support for the economy just cannot afford high interest rates. So that's my theory. So the fear of rising interest rates is less of a concern. So when you lock up the shorter duration, well, that's the worry and the risk. If you come to the maturity and the rates are higher than today, then it's a challenge to refi. Yep. But my personal opinion, and I could be wrong, is that we just now are going to see higher rates. We are where we are. We may stay here, and if we can't go into negative rates. So I'll kind of. But let me continue with some other questions. So non-self-storage, you've been dealing with a little bit of COVID impact. How have things been going? Have you made progress with your tenants? Have they been able to reopen? And you're in Denver. I don't know what's the political theme in Denver and how things are. Are they, is the city reopening? What's been going on?
Yeah, I'll talk about the effect of COVID briefly on our retail portfolio, and then I can talk about our effect we're seeing on self-storage as well. On the retail side, when our shutdown first happened in Denver back in March, we automatically gave our retail tenant base 2 months of deferred rent, not free rent, but deferred, just in the hopes that would help them get through this, get their PPP funds, and reopen in June. And all of our tenants have reopened successfully with the exception of one. And she was a gym concept and just decided it didn't make sense to try to hang on. So she got out of her lease, but the rest of them had opened up and are good to go. But April and May were obviously tough months from a revenue perspective when you go from a lot of rent to no rent. But we're hopeful that things are going to continue to improve. As far as what's happening in our city, we're back open for business. There are some restrictions on bars closing down earlier. And there's obviously physical occupancy restrictions at restaurants. The city has been pretty good at allowing users to open up patio space in public areas and right-of-ways, like closing part of a street down, for example, for patio space, or closing a sidewalk down that normally wouldn't be allowed for patio space. So that's helped a lot. As it relates to our self-storage portfolio, we haven't seen any major impacts on it. The negative things we have seen was our leasing velocity for May and June, which are typically pretty buoyant times of the year for self-storage leasing, were lighter than we expected. Net leasing was still positive, but it certainly wasn't at the clip we were hoping for this time of the year. Our delinquency rates, though, which we're pleased to see, have not increased. They're in line with where they typically are this time of the month and this time of the year. Nationally, one thing we track pretty consistently is national street rates on 10 by 10 non-climate controlled units. And it's obviously a big net to cast when you're talking about national numbers, but those roughly went down year on year from June to June by about 4.5%. The good news is it feels like that's bottomed out because there wasn't a further increase on July numbers. And with our portfolio, we did see a nominal increase in revenue from June to July by about 3%. So we feel like things have kind of bottomed out in the self-storage sector. With that being said, we still have the headwinds of a lot of markets that are hyper supplied. Markets like Charleston and Denver, which is obviously our backyard. A lot of new product was built, and you touched on this earlier, Mike, but self-storage is so sensitive to the local supply ratios. Once you get over 8 or 9 square feet per capita in the 1, 3, and 5 mile trade radius, you really start to see a meaningful drop in occupancy and rates, and it kind of becomes a race to the bottom. So we do have the non-COVID headwinds nationally of dealing with a lot of new players in the space with a lot of new ground-up construction projects happening. But from a street rate perspective, and as it relates to COVID, it feels like things are starting to stabilize, but this whole thing is obviously month by month.
Yeah, I hear you touched on a number of really, really great points. The oversupply is a risk. How do you protect against that risk when you get into projects? I mean, you can't protect against somebody just deciding to convert an old dysfunctional mall into a self-storage facility, right?
Yeah, you can't. There's some subjective ways and objective ways to protect against that. We try to focus on facilities that we can have a total capitalization that is equal to or less than replacement cost. So if someone were to build a facility nearby us, their rates would need to be substantially higher than ours to achieve the same total yield on cost, given that their basis is higher. Obviously, it'd be a little bit nicer facility because it's brand new, but storage is to a degree a commodity. It's almost like stopping at the gas station. You don't want to stop and get gas necessarily, but you need to. And you're typically gonna pick the most convenient location, and maybe you're gonna look at price, maybe you're not. Other ways we try to mitigate against that is when we can, we select acquisitions in municipalities that are averse to new self-storage development. And it's always possible someone's going to get a project approved, but if you have a local government environment that does not want more self-storage supply, chances are you're not going to see new supply in that submarket for the foreseeable future. So really replacement cost and kind of local government conditions are two things that we look at from a risk of new supply perspective.
Yeah, you got to know some local politicians and get their thoughts on. Generally, cities don't like a lot more self-storage. They already had oversupply, but all these dysfunctional malls and COVID broke that whole sector even harder now. Yeah. So what's going to happen with all these big retailer boxes?
The challenge on these retail conversions, we've looked at a number of these over the years, is the cities are typically really resistant to changing the zoning that the project is under. So they'll believe that some big box grocer is going to come in at some point down the road, even though the project has been vacant for 5 years and there's weeds in the parking lot and, homeless camps outside. They still kind of hold on to the hope that someday a retailer is going to come in. And because of that, they've been typically resistant to changing the zoning use to allow for self-storage conversion.
Yeah, great.
A lot of folks get those done though. It's just it's a lot of heavy lifting on the city side.
You sort of wind up getting involved into politics. So dirty sport.
That's right. We got to be careful how deep we go there, right?
That's right. Sounds great. Brilliant commentary. Appreciate your wisdom. We're almost out of time. Final thoughts, and how would people reach out to you if they're interested in your funds, want to chat with you? What's the best way to get a hold of you?
Yeah, people can hit me on LinkedIn or go to our website, www.vanwestpartners.com, and always looking to make new contacts. So appreciate you throwing that out there, Mike.
Thank you very much, Jake. Pleasure and a privilege to have you once again. Always great talking with you. Great insight on self-storage and great commentary. Got to do it again. We'll wrap up this episode. We're out of time, but we'll do another one soon enough. So thank you kindly.
Thanks for having me, Mike. Take care.
Yeah, you too. Take care.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.